From New York City for our viewers worldwide, I'm Manus Cranny, in for Jonathan Farrow this Monday morning, desperately trying to find our footing this morning. Equities just turning slightly into the green. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up, stocks trying to rebound from their worst week since October. Congressional leaders announcing a bipartisan spending deal, and Boeing under pressure as carriers ground the 737 MAX jets. We begin with the big issue, bracing for a big week ahead.
News items, I think, that are big for this week.
CPI coming up this week.
CPI number could be very influential in that market pricing and rates.
Do we get a slight reacceleration?
The Fed, I think, wants to really put that inflation genie back in the bottle.
They need to follow inflation.
Those banks' earnings.
Bank earnings.
Are those sort of strong numbers that we've seen in terms of performance going to hold up?
We are expecting a slowdown in growth.
We really go in and look at the financials for clues on the plumbing of the economy, on the health of the consumer.
The backdrop of geopolitics as well.
We've got tensions boiling in the Middle East, but not spilling over into crude prices.
We've got, Congress back Monday and Tuesday.
The hard work gets to begin now.
It's a major source of uncertainty.
We're kind of trapped in this economic narrative where people are uncertain.
Join me now to discuss the risk for the week. BlackRock's Tony DeSpirito and Subhadra Rajappa from Societe Generale. Here we are. We are desperate to put in a sure footing this Monday morning. Subhadra, let me bring it to you. First of all, I look at the flow. There's monster flows into cash, way outpacing those into equities. How do you look at risk this Monday morning? What does it take to assure you it's time to deploy?
Yeah, I think it is kind of a dicey time because you are seeing money flow back into money market funds. Money market fund AUMs are at the highest levels they've been. So there's a little bit of caution from the markets heading into this year because there's a lot of uncertainty on the policy front. There's also uncertainty on the geopolitical front. So I think investors are being a little bit cautious heading into the beginning of the year and where they want to deploy cash. We've seen a pretty significant run up in both equities as well as fixed income in the last couple of months of the year. Financial conditions are extraordinarily easy. The expectation is that the Fed will cut rates at some point. The question is when and by how much.
Yeah, and that is getting trimmed and extended would be my take. Tony, let's roll it out to you. You say safety is not without risk. So I put it in, I get 5 1/8 in a CD, but you say I'm giving up a runway of risk.
Yeah, well, I think we have to look at history as a guide, and history would tell you that investing in equities, particularly the S&P 500 for the long run, has been the best performing asset class. And I use data going back to 1957, which is when the S&P 500 was created. And guess what the average 10-year treasury was over that period of time? 5 3/4%. So well in excess of today's 3.9, 4.0%. What that tells me is that, yeah, bond yields feel high, and same with money market. They feel high relative to our recent history, but they're well in line with long-term norms. And that tells me equities are still a very good place for investors to be.
Okay, well, really all that we're doing is returning to the 1990s, a little bit of volatility, rates over 5%. And you know what? The world didn't stop then. Subhadra, let me bring that to
you.
Exactly. Unfortunately, I'm mentally scarred from the 1994 bond meltdown. 10-year treasuries, the yield to decline to 3.75 by the middle of this year, but the rise again later in the year to 4% as QT and supply gluts continue to weigh on the long end to rebuilding of term premium. The term premium returns. Subhadra, let me bring that to you first of all. I had BlackRock with me on Friday. They wanted to jump in here. They wanted higher diving boards to jump in. Do you think this is rich enough to dive in here? And then just talk me through your thoughts on term premium. What kind of scale of term premium returns?
So between now and the middle of the year, we think that the market's going to be very much focused on the slowdown in the data. We did see some, the jobs report was very strong. We are seeing some signs of a slowdown in the pace of job creation, as well as in the job market, generally speaking. We think that the U.S. economy goes into recession sometime in the middle of this year. So that in and of itself would mean lower yields from here on. So we think that 10-year yields could rally from around 4.10 now to maybe 3.75. But beyond that, what we're looking at is the trajectory for debt and deficits. I was actually surprised that they were able to pass a deal to avert a government shutdown preemptively. I think that there's very little will, if you will, from Congress to be able to rein in debt and deficits. So if issuance is going to continue to climb and the Fed is going to continue to run off its balance sheet, at least till the middle of this year when they perhaps lower down that cap, and beyond that into the end of this year, then I think you're going to see a rebuild in term premium because someone has to absorb that supply and they're going to demand a term premium.
Yeah, and I mean, by the way, there's still a road to go before we avoid the close down and the shutdown. There's a few holdouts that I'm sure will hold our risk feet to the fire. Tony, given the landscape that you see in front of you, these equity markets took in less than cash. Everybody's telling me it's all about breadth. It's all about the equal-weighted S&P that I want to be invested in. I want to look for breadth in 2023. What does that mean to you?
Yeah, so the big opportunity that gets me really excited, yes, 2024. The big opportunity that gets me really excited is the opportunity for stock picking, right? Everyone talks about the S&P, is it going up, is it going down? What's really interesting to me is stock picking. And I think when you look at the equally weighted versus S&P versus the cap weighted, you see this big gap in valuations, almost 20 percentage points. Historically, that valuation gap has been pretty close to zero. I know there's an old expression, it's not a stock market, it's a market of stocks. I really think that applies in 2024. And we even saw it at the end of last year. We saw breadth starting to grow again, the market widening out. That's a really good environment for stock pickers. And so what we're trying to do on my team is exploit some of the anomalies we see. I see defensive stocks as being very attractively priced. I think that's great, particularly given that we're late cycle. I see value stocks. I see a lot of opportunity in value stocks. So the fund I run, the BlackRock Equity Dividend Fund, my PE discount versus the S&P is the largest it's been in the 10 years I've been running the fund. And then finally, I'm seeing select opportunities outside the United States. The U.S. market has done so well. There are some really good companies outside the U.S. that have been left behind. They're global businesses. They're high quality. I've got about 20% of my portfolio in those companies. So those are the anomalies I see, and I'm really excited about those.
Okay, everybody shouts me down on this show. So I'm a transplant from the Middle East and from Europe, and everybody shouts me down when I say, hey, there are some stocks beyond these shores that you might want to be invested in. Stay with us, team. We've got a little bit more work to do. Investors are bracing for a busy week ahead on the inflation front. Mike McKee is with me side by side for a preview. So this core CPI, Mike, should be tempered and should embolden the bond markets. That's the theory.
Well, that is the theory. We've got a busy week ahead, and CPI is the highlight. It comes on Thursday. Some numbers out today, including the New York Fed inflation expectations, may move the markets a little bit. And as you can see, we've got some Fed speakers, Bostic, Williams, and Kashkari talking about the economy, Barr talking about regulation. But it will be CPI that gets the focus because, as you noted, the core rate is supposed to go down. However, the headline rate is supposed to rise by 1/10. And that's a question going into that day of what the markets are going to do, because last week, when the European Union had the kind of numbers, and this is all based on base effects rather than real changes in inflation. When the Europeans had that, the markets backed off. The markets got nervous. Now they have reversed that, and does the U.S. already have this priced in for the big change? We'll see on Thursday, and we'll get an indication during the week of what the Fed thinks of both the jobs report and the CPI report. Lori Logan spoke this weekend, the Dallas Fed president. She said that growth is settling down but not collapsing. The labor market still looks tight after the payrolls on Friday. Financial conditions may actually, she said, turn into a tailwind this year. That's a concern concern for some people, and they can't take a rate increase off the table. Most people in the market's not paying a whole lot of attention to that idea, but it is still out there. And then, of course, she said we should slow balance sheet normalization as we get closer to the bottom level of ample reserves, and nobody knows quite where that is, but she's sort of the first smoke on the horizon in terms of that discussion.
That is a hawkish piece of pie that you're waking up to this Monday morning. Mike, thank you very much. Mike McKean, Tony DeSpirito and Subhadra Rajapal are my guests this morning. Rate hike and a bit of QT, what would that do for you? Tony, let's take it to you first of all.
Yeah, so I think one of the there's lots to be positive about in this market, but one of the challenges for investors is the fact that we are late cycle, right? If you look at the unemployment data, 3.7% unemployment, and that means the Fed really has a tough job of threading a needle. Raise rates too much, you risk recession. Not raise them enough, you risk inflation coming back up again. And so I think that's the challenge for markets. So far, the data has been excellent. We've gotten slowing inflation, yet the economy is held up well. But that's something we've got to continue to watch.
So, Subhadra, do you think, look, no, I'm going to put words in your mouth, but feel free to push back. No probability of a rate hike, but you can turn the screw tighter with QT if you need to.
Yeah, absolutely. I think Lori Logan lays out the risks to policy for this year very clearly. On the one hand, you do have an easing of financial conditions, which is probably going to delay the impact of higher interest rates. We're not in the camp that the Fed would need to hike again this year. We think that they're done hiking. They'll probably cut rates by about 150 basis points. But QT, I think, after they kind of bring down the pace of the runoffs, I think they'll let it run for as long as they can, just to make sure that the balance sheet is in line with where it was prior to the crisis, because they really, to the pandemic, I should say, they really ramped up the balance sheet. So our view is that they'll have QT or quantitative tightening well into the end of this year and perhaps even into early 2025.
So here's one that the world is looking at, but not really. It's sort of like, hands over the eyes. 12% of the global trade is rewriting round the Horn of Africa. This is, in many ways, reminiscent of some of the disruptions that we had going into the pandemic. Tony, to you, is this just a temporary blip in geopolitics and 12% of the world's trade is rewriting, or should I be more concerned about that flashpoint?
Well, one of the things that we've talked about, and this is one of those long-term inflationary risks, and I think long-term volatility risks, right? Which, remember, I think volatility, as an equity investor, I like volatility from a stock picker's point of view. But I do think one of the drivers of longer-term volatility is going to be geopolitics. And I think what's going on with shipping the Red Sea, that's just an example of that. And so that's one of the things that we've been saying is, over the last maybe 15 years, things have been too good in terms of volatility just being too low. We expect volatility to normalize upward. Again, like we were saying earlier, more like the 1990s. I think that's good for stock pickers.
So good vol, bad vol. And I suppose the way to look at maybe this tech drawdown is a little bit of volatility, gives me an opportunity to re-enter on perhaps some of those Magnificent Seven if I was under my allocation to those, Tony. Just quickly on that.
Yeah, no, I do think that's right. And I think a lot of what you saw last week was just a bit of a reversal of what we saw at the end of the year. You saw very strong semis, very strong market, strong growth factor, strong beta. That just came off last week. So I think last week was just kind of a healthy little correction to the exuberance we saw at the end of the year. But exactly, you could use that as an opportunity to reload.
Rational exuberance or irrational exuberance, we can debate. Tony DeSpirito and Subhadra Rajapal stays with me. In the meantime, let's get up to speed with some of the stocks that are moving ahead of the opening bell. Abigail Doolittle is with me. Abby, that Boeing stock under pressure pre-market.
Indeed. We have Boeing down, Spirit AeroSystems, Alaska Airlines, and United. This, of course, after that mishap on Friday when an Alaska Airlines 737 MAX 9, its door plug blew out during the plane's ascent. event. The plane depressurized, a shirt, a cell phone, and a teddy bear were sucked out. Thankfully, the plane did arrive safely back in Portland about 30 minutes later. It's not known what is behind this. That Spirit Aerosystems makes the fuselage panel. That stock really plunging. As for Boeing, given the 2018 and 2019 737 MAX 8 tragic crashes, this is very bad news. The last thing that they wanted was the FAA back in the mix, but the FAA has temporarily grounded the 171 737 MAX 9 aircraft around the world, mainly in the U.S., mainly used by Alaska Airlines and United. Now, ahead of Friday's flight, Manus, this plane in particular, just 2 months old, a pressurization fail light had lit up so that the plane said that it couldn't go on long flights. It's unknown, though, whether that is somehow connected to those wild events last Friday.
Yeah, well, it certainly causes major concerns for the turnaround plan at Boeing. Abby, thank you very much. We'll see you through the morning. Coming up on the show, Congress announces, you got it, a bipartisan spending deal.
We now have top-line agreement on what we can spend for the fiscal year. That's great. It's wonderful. And that just means that the hard work gets to begin now.
The latest developments from Capitol Hill on the way as Congress gets back to work. That conversation up next.
We now have top-line agreement on what we can spend for the fiscal year. That's great. It's wonderful. And that just means that the hard work gets to begin now. There are so many points of departure between Democrats and Republicans when it comes to the specifics of the spending agreement. There are upwards of 40 different poison pills some groups have counted that could shut down the talks around this. So, look, I think that the temperature has been taken down. The risk of a shutdown is slightly lower this morning, but there's still a lot of work that needs to be done over the next 11 days.
Congress racing to avoid the shutdown, reaching a $1.59 trillion top-line spending deal. Now, the problem is this. The plan doesn't include President Biden's aid to Ukraine, along with some stringent border protections backed by the GOP. That sets a potential battle royal between the White House and the Speaker, Mike Johnson. The Speaker is likely to use Ukraine to squeeze Biden on the immigration changes. And we've had some polls. The CBS YouGov poll says 63% of respondents want Biden to be tougher at the border. What does that mean? How does that translate? Kayleigh Lyons is with us. So, Kayleigh, here we are, a theoretical deal of $1.59 trillion. But, of course, the Democrats have a side deal as well. So what extra did they get?
Well, basically, this just leaves intact a deal that was made months ago, Manus, between President Biden and Speaker McCarthy, the Fiscal Responsibility Act that helped avert a default by raising the debt ceiling. Largely, those figures are intact, including $773 billion for non-defense discretionary spending. Now, there were some wins for Speaker Mike Johnson here, a pulling forward of $10 billion worth of funding cuts for the IRS, as well as the rescinding of $6 billion of COVID relief funding. So $16 billion in total cost savings that he can tout to his conservative colleagues. The question is really, is that enough for them? Indications are for at least some, like the House Freedom Caucus, no, they say this deal is worse than they thought. And there also, as you were alluding to, Manus, is the issue of the border. There are a number of Republicans in the House who are saying they would like to shut down the government if they don't get what they want in terms of border policy reform. That raises a very big question as to what exactly the path forward is into finding an agreement that the White House, the Senate, and the House of Representatives can agree to. Potentially Mike Johnson going to talk directly with Biden about this matter, but it may be that border security is both key to unlocking, the supplemental funding request, including aid for Ukraine and Israel, but also keeping the government funded by the time January 19th rolls around. And even though we have these top-line figures, Manus, everything has to be divvied up now into actual appropriations bills, legislative text that has to be passed, at least 4 of them, by January 19th to avert that partial government shutdown. So really, a lot of work is still ahead.
Yeah, there is a lot more technical work to be done, Kayleigh. Thank you very much, Kayleigh Lyons, there with the very latest on the theoretical cap on spending. Tony DeSpirito, Subhadra Rajapaksa is my guest this morning. There you go. You have a theoretical top in spending. Are you ringing the rejoice bells, Subhadra, in terms of the fiscal situation? Because in the end of the day, the fiscal agreement is the narrative that will define the Treasury supply.
Yeah, no, I'm definitely rejoicing the fact that there's a potential that we won't have a government shutdown in the next couple of weeks. But the fiscal situation is far from resolved, as you heard from one of your guests earlier on. We still have a trajectory for debt and deficits that's quite dire for the next 5 to 7 years. We're expecting increases to coupon issuance sizes again at the next refunding meeting. There's just a lot of supply that's going to hit the market, and we have to find ways for the market to absorb that additional supply. I think that, especially given that this is a election year, I think it's going to be really hard to come up with very concrete measures to be put in place to be able to deal with debt and deficits. We do have the Trump tax cuts expiring next year. That could alleviate some of the deficit issues. But broadly speaking, I don't really expect a whole lot to be done on reducing the deficits in the next in this year.
And that's a whole host of political issues in regards to the tax cuts from the Trump era as to whether Biden will stand behind those. $52 billion of three-year notes coming down the pike today. Tony, very briefly, in 30 seconds, election year, you don't expect a squeeze in terms of spend this year?
No, I mean, if you look historically at the presidential election year, it's a positive year for equities. It's slightly below average positive, but it's still a positive year. I see no reason why this year won't be similar.
Okay. We'll ring out the bells for stocks if those earnings come through. Tony, thank you very much. Tony DeSpirito and Subhadra Rajapan, my guests this morning on the markets. Coming up, we'll get you the morning calls. Citigroup's Stuart Kaiser makes the case for stocks with the big bank earnings kicking off on the slate on Friday. That conversation next. This is Countdown to the Open. I'm Manus Cranny in for Jonathan Farrell. We're desperate to try and put on some risk on this map. It's been the worst start to cross assets in almost 2 decades. Boeing is the drag, down by over 8% in this opening sweep. We'll keep an eye on that in just a moment. But in the meantime, let me get you up to speed with some of your morning calls from the analysts. First up, Citigroup downgrades Pulte Group to neutral, growing concern about the business model. And falling interest rate environment. Next up, Bernstein downgrades Southwest Airlines to underperform, expecting secular and idiosyncratic cost pressures to weigh on the earnings. And finally, Baird downgrades Wells Fargo to neutral, seeing a more balanced risk reward after outperforming in 2023. How do you fancy your banks? Earnings season kicks off on Friday. Will Wall Street banks define the risk? We'll ask Stuart Kaiser. We're counting down to the cash open. Are you feeling brave enough to deploy money into stocks? The money market funds and cash have gorged. They took in the most amount of cash in the first trading week of 2024, pretty much on record. There we are. We're going to roll over onto the cash opening. 2 big drags. One is Apple, one is Boeing. We'll keep an eye on that. But you're looking at a flash of green across those equity markets at the moment. We'll get you the details on some of the others. Across the assets, this is what you got. The dollar, by the way, had a pretty stupendous start to the year. The euro eking out the smallest of gains, up an eighth of 1%. The dollar on the back foot. Yields drop in the United States of America. BlackRock were with me on Friday. They wanted to step in here. They found the higher diving board to buy bonds. Is it rich enough and high enough for you? Crude drops by over 4%. The Saudis are cutting the price of crude to their Asian market by $2. This is having a pretty negative impact on sentiment, and it underscores the risk of a softer global oil market. One stock to watch, it is Boeing. The shares are poised for the biggest decline since 2022 as the airlines ground the 737 MAX jet. That was after an incident with Alaska Airlines. Abigail Doolittle is on the story. So, Abby, here we are. This is a real blow to Boeing, a blow to confidence. And if I was getting on one of these things, I'd be pretty nervous at the moment.
Agreed. I don't think I would be getting on one of these planes, but right now you can't, because the 171 737 MAX 9 planes mainly used in the U.S., well, they have been grounded by the FAA. This, of course, because of that wild incident you were alluding to on Friday, where passengers literally feared for their lives. A door plug or a piece of equipment that goes into the hole of the side of the plane where an emergency exit could go, it blew out. This as the Alaska Airlines plane, that 737 MAX 9, was leaving Portland. The plane quickly depressurized and then oxygen masks dropped back down. Within 30 minutes, thankfully, the plane did move back to land back in Portland with nobody hurt. Now, that fuselage panel has been recovered from a Portland teacher's backyard. Spirit Aerosystems makes that piece. Those shares are plunging. But you were mentioning Boeing in this turnaround. So, of course, unfortunately, they had those incidents in 2018 and 2019 when 737 MAX 8, those tragic crashes. So this is very bad news. They've been trying to stage a turnaround, even showing that something could happen with China. There had been encouraging movement there, but now with the grounding of these planes by the FAA, and also it's not clear what caused this. This was a brand new plane, Manus. It had been in the air for about 2 months. In some of those previous flights, a pressurization fail light had lit up 3 times. For that reason, this plane was not allowed to do longer flights. They're not sure if that's correlated, but what we do know is Boeing on the day down 9%, down more than 10% this year, and now down about 50% from its 2019 peak, really not recovering from the issues that it's had with these MAX planes.
Okay, Abby, thank you very much. We'll track that stock through the morning for you. And the Boeing news is spilling over into other areas in the market. As Abby just said, you've got United and Alaska. Those are the two airlines, the two carriers here in the United States that fly the MAX 9 models. They're falling sharply at this opening bell. United turning around up 0.5%. Of course, the much bigger impact is on Alaska in terms of their schedule. It takes about 4 or 5 hours, we understand, to review these escape hatches. Let's talk a little bit more on the markets with Simone Foxman. Simone, what have you got?
It may take 4 or 5 hours to review these hatches on all these planes, and that's why United and Alaska had initially contemplated returning some of their MAX 9 jets to the air on Saturday after they'd completed those reviews, but then later in the day ultimately decided not to do so. I'll give you some numbers here about how many jets each of these airlines has. United has about 79 MAX 9 jets, Alaska 65, and Monday flights are also being canceled after a weekend where there were 270 flights canceled for United, 163 for Alaska. That amounts to about 1/5 of Alaska's overall flights. Alaska saying these groundings could continue through at least midweek, but Raymond James kind of downplaying this, comparing this to a bad winter storm for both these airlines. Others, Spirit Air, for example, flies the MAX, but it doesn't fly the MAX 9 and therefore doesn't appear to be impacted. Truist and Bloomberg Intelligence, however, say the real focus is going to be on Spirit Aerosystems. You can see it's down now. They're over 12%. It has already faced a series of quality control issues over the last year. This is a spin-off of Boeing that still makes a lot of its parts for these major planes. And so a lot of focus there this morning as we get into the start of early trading, Manus.
Yeah, a lot of commentary, Simone, over the weekend about perhaps the management culture, the changes that may need to be taken on board at Boeing. And this is just another moment of deep reflection. Simone, thank you very much. Let's turn our attention to Tesla. We have a journal report over the weekend saying Elon Musk has used illegal drugs and has the board of the EV maker worried. Let's get to Alex Semenova on the story. Alex, and of course, Mr. Musk was on Twitter yesterday pushing back on this.
Indeed, Manus. Good morning. Tesla board members and executives are once again dealing with a very familiar problem, and that is Elon Musk's behavior. Their latest concern is his use of illegal drugs, including LSD, cocaine, ecstasy, psychedelic mushrooms, and ketamine. Quite the variety there. This is according to a report from the Wall Street Journal that says that he's used these drugs at parties around the world, often parties that require non-disclosure agreements to enter them. The report also said that he used illegal drugs with Steve Jurvetson, who is a current SpaceX and former Tesla board member. Musk responded, of course, to these allegations on X, the website formerly known as Twitter. He said that he agreed to 3 years of drug testing after infamously smoking marijuana in a podcast with Joe Rogan a few years ago. And those tests reportedly reportedly found no traces of substance use. He also said that he has a prescription for ketamine to treat depression. Now, Tesla investors have often overlooked concerns about Musk's behavior given the performance of the stock under his leadership. Tesla shares are up about 1,000% over the past 5 years, even after falling back in 2022. This includes a gain of more than 100% last year. Still, though, Musk's behavior continues to be a concern for board members and Tesla executives, so much so that one board director reportedly refused to run for re-election. That's according to the Wall Street Journal report. Tesla stock has started 2024 with a bit of a limp. Shares were down as much as 4% as of Friday's close. And they're heading lower again today.
Okay, just an eighth of 1% off the stock, 237 on the open. Alex, thank you very much. Let's turn our attention to the earnings slate. Lululemon raising its guidance for sales and earnings after a strong holiday period. Katie Greifeld is with us. Katie, have you been in a Lululemon in the past couple of weeks? Absolutely crowded.
Not in the past couple of weeks, but definitely in the past year or so. But let's talk about what's going on right now, because shares are dropping despite that guidance boost. Manus, the athleisure maker, now expects earnings between $4.96 a share to $5 a share. That is for the fiscal fourth quarter. Previously, that range was between $4.85 to $4.93. Now, Lululemon also expects net revenue to fall between $3.17 billion to $3.19 billion. Analysts were looking for $3.19 billion, so the top end of Lulu's given range. So it's an upgrade to guidance, but evidently not enough to get traders excited here, especially given that this was largely expected. Last month, for example, William Blair had written about the possibility of a guidance boost. That's what you saw today. This is still good news for Lululemon. Lululemon CFO Megan Frank said that sales across all categories, channels, and geographies are, quote, balance that is driving this better than expected performance. And it might help explain why we're seeing Lululemon pare some losses here, currently down about 1%, had been about 3.3% lower pre-market. Manus.
I found an alternative brand, but you'll have to ask me about that off air. There are other brands apart from Lululemon. Okay, Katie, we'll leave it there. Katie Greifeld with the very latest. So the biggest US banks unofficially kick off the earnings season later this week. Bank of America, Citigroup, JP Morgan, Wells Fargo, all will deliver their results on Friday. We will get a greater understanding of our future, won't we? Stuart Kaiser is with Citigroup today to go through these markets. So let's see what the narrative is, the recession, the credit card numbers, etc. Park that for just a moment. I want to hang my hat on your bullish call, because you say cross-asset vol isn't so bad, it's fairly repressed, the ISM wasn't bad, and we had a jobs report which confirmed, if not the immaculate disinflation, but a quasi-soft landing. What the heck is there not to like and love stocks?
Hey, good morning. I think that sort of summarizes it for us, which is, underlying growth data remains strong. Inflation data is kind of, trending lower, a bit higher than you might like it, but, kind of going in the right direction. And then, as you mentioned, earnings kick off later this week. And I think the key theme of earnings for 2024 at large is, do they broaden out? We saw pretty narrow earnings growth last year, which in our view, drove pretty narrow leadership in equity markets. And we're hoping both of those things can, sort of take up a larger group of participants as we move through 2024.
How much of a pro-risk stance is predicated on 6 rate cuts versus 3 rate cuts? Or is it, look, that would be nice to have, but I feel convicted on earnings?
Yeah, I think we're a little bit less concerned about the rate cut dynamic. I mean, if you think back to 2023, there was a period of time where you priced almost 100 basis points of rate cuts into the back half of 23, and equities were able to perform quite well even as those rate cuts got priced out. And the reason was underlying growth data was very strong and was surprising consensus estimates. So I think if you're in a similar situation this year, which is underlying economic growth is strong and those rate cuts get priced out, I think equities can do quite well in that environment. The risk would be those rate cuts get priced out because inflation kind of turns higher. That would be, I think, a very negative outcome. And I think our view on rates at large is the why matters. If you're cutting rates because of recessionary conditions, that's quite negative. If you're cutting rates for insurance purposes, that's quite positive. And if you're raising rates because of inflation, hooking back higher, also quite negative. So, big picture, we're not too concerned if those rate cuts get pushed out, as long as it's being driven by healthy things, and that would be good growth data.
I just had Tony DeSpirito with me at BlackRock, and what I find interesting, he's one of the first major analyst to join me in this new journey 4 months into the United States of America. He said he had about 20% of his portfolio beyond borders, i.e. outside the United States of America. There are companies, in his view, that can be worthy. To what extent do you want to have a global proportion beyond borders in 2024?
Yeah, I mean, it's a great question. I think last year, early on in the year, people tried to, take a shot at Europe. I think mid-year, Japan was a very popular trade. And I think throughout, people did try to kind of catch a falling knife in China. Some of those trades worked, some of them didn't. I think our view in general is, hey, if you're growing earnings 11% in the U.S. and you've got, the Fed poised to cut rates and a solid growth environment, I think you can probably find pretty strong risk reward in the U.S. itself. So, not a huge appetite right now to look outside the U.S. Just because, again, we think the opportunity is pretty strong in the U.S., whether that's in S&P equal weight or small cap or even some of the cyclical parts of the market that lagged last year. You might even throw banks in that category as well. So, look, I don't think there's a negative outlook outside the U.S. At this point, I think you can get pretty effective risk reward by staying domestically.
You say there's a 40% chance of a 10% bump in the S&P in 2024. Is that going to be slightly more, given what you've just said to me, is that going to be slightly more value to growth?
It could be. I think that's what we've seen early in the year is some money going into value, going into your cyclical laggards. Certainly, that's a 40% chance the S&P is up 10%. I think probably as interesting there is there's a much higher chance of very big upside price into small cap. And I think that would get into the topic you're discussing, which is, do people rotate into this kind of lower quality value stock as the year goes on? And I think it's possible. We do like S&P equal weight to express that view. But again, that's going to be predicated on growth. And I think if you have strong growth data, then that makes growth less scarce. And I think we'll get people kind of more interested in that value and cyclicals trade. But again, I think it all comes back to economic growth and how does that labor market hold in, at least through the first quarter of this year.
And wages are strong, so the consumer you remain convicted on the consumer. There was a wonderful line from Paul Donovan a few weeks ago. Never underestimate or never bet against the U.S. consumerism, the hedonism of the U.S. consumer, and I'm supposed technically one of those now. What's your thinking on the U.S. consumer?
Look, I think the rumor of the consumer's demise has been kind of greatly exaggerated throughout most of 2023, and I think part of that is just because we did a lot of fiscal spending in the U.S. and part of that, as you mentioned, wages have been strong and the economy has been strong. So, I think for now you just have to assume or hang your hat on the idea that the labor market and services spending remains strong, and you want to run U.S. equity risk. Our view though is the moment you see real confirmed weakness in that labor side of the economy, you need to reduce your equity risk pretty quickly and be very cautious about getting back in. So, look, whether it's credit card delinquencies or rising jobless claims, things
is that
of that
why
nature,
the banks? Is that why the banks reporting on Friday will be so important, Stuart?
Yeah, I think the banks reporting, I think you touched on the three big topics, right? Is generally speaking, bank CEOs have been very cautious about the economy. They've been increasing credit reserves. And we've had a relatively slow deal calendar through much of 2023. So the question will be, what is their view on the outlook of the economy? How do they see that credit risk playing out over the next 12 to 24 months? And are they optimistic about an improving deal calendar? So I think those are the three big topics. And the first two of those, credit risk and economy, to your point, really play directly into that view.
Okay, Stuart, thank you very much. Stuart Kaiser, you stay with us. We've got more work to do coming up. We touched on this, but Saudi Arabia, they're cutting their oil prices.
I think OPEC is definitely part of the equation, is a key part of the equation here. The Saudis, I have a hard time seeing them cutting further. Remember, they've been at 9 million barrels a day now for 8 months or so. And in reality, that's the lowest level of production since 2011, if you exclude the COVID period.
Oil prices remain under pressure, as you can see. That is not just pressure, that's brutal. Crude down by 4.66% at 70.41 in the US. Brent collapses by over 4%. We continue that conversation in just a moment.
I do think that geopolitics are a major issue, but it's something really hard to price for markets. So I think OPEC is definitely part of the equation, is a key part of the equation here. The Saudis, I have a hard time seeing them cutting further. Remember, they've been at 9 million barrels a day now for 8 months or so. And in reality, that's the lowest level of production since 2011, if you exclude the COVID period.
Bank of America's Francisco Blanche with me a little bit earlier alongside Danny Berger on the oil markets. Crude is absolutely getting pummeled this morning, down nearly 5% on WTI, and likewise on Brent, down 4 1/4, 75.37. So this market is under pressure. Julian Lee is with me from London. This is quite a chunky move, down 5% on WTI. The Saudis cut prices by more than we expected. Can I put it all down to that?
I don't think it's all down to that. I mean, I do think that's a significant part of it. What the Saudis have done is basically sent a message confirming that they're having difficulty selling their barrels at the sort of prices they were asking. And of course, these price cuts by the Saudis, they're not done in absolute terms. These are done relative to the benchmarks. So this is relative to Brent and relative to WTI. So as those fall, the Saudi prices are going to fall even further. But I think this is really a recognition that the Saudis are struggling to sell the barrels they want to sell, particularly into places like China, which are, facing real competition from discounted barrels from Russia and barrels from elsewhere. And all of that coming in large part because of this huge increase in US production and increases from places like Brazil and Guyana.
Okay, Julian, thank you very much. Julian Lee there, setting the stage as oil markets come under pressure. My guest this morning is Stuart Kaiser. I mean, Stuart, from an equity point of view, you've got write-downs coming through. You've got a number of different issues at play there at BP in terms of leadership. Here we are on the commodity side. I've got Jeff Curry coming on the show earlier this morning talking about this is the classic own commodities. He's an Uber bull. We know that. Do you temper your inner commodity Uber bull?
Yeah, I think commodities and oil in particular have just been a really frustrating trade for folks, through much of 2023. If I told you U.S. growth was going to surprise to the upside, you were going to have wars in two oil-producing regions, and OPEC would be cutting supply, I don't think you would have expected oil to behave the way it did. So, I do think investors got kind of frustrated trying to play that upside trade in oil. It's been a benefit to the U.S. consumer, obviously, that we haven't seen oil prices, rise more quickly. And to Julian's point as well, U.S. production, if you look at that chart, it's at an all-time high. So, clearly the U.S. is trying to fill any kind of supply hole that's being created by OPEC.
I mean, the two big areas in the market are oil on buybacks and dividends and banks on buybacks and dividends. Correct me if I'm wrong, but to what extent will they drive the baseline engagement in both those sectors?
Yeah, look, it's hugely important, on both sides of that. I mean, I guess, in theory, you'd probably assume that the buybacks would have a little more kind of wiggle room to them than dividends. Companies are usually very, very cautious about cutting a div, but maybe see a little bit more flexibility in the buyback path. But look, both of those sectors, energy is committed to returning cash to shareholders, and I think banks are happy to return as much as they're allowed to, by regulators. So my guess would be both of those sectors return as much as they possibly can, and the question is that going to be enough to satisfy, where consensus is at this point? And probably a little bit more risk on the energy side than on the bank side would be my guess.
Let's just close off with where we are. Stocks and bonds. Stocks had a shakedown. Cross assets had a shakedown since the start of the year. Do you want to be a coupon clipper, as one client said, as one guest said to me on IB, in terms of very short date? Does cash play any role for you in 30 seconds? Cash or T-bills, Stuart?
I mean, of course it does. When you have cash yields at the level they are, when you've had, $800 billion going to retail money markets in the last 12 to 15 months, clearly that's a key aspect of things. I think the question is, if you're sitting here and you expect growth to remain strong and you think your cash yield is going to be declining as the year goes on and you just missed, a very large rally in U.S. equities, does that get retail money back into the market? We think it probably does. Not a wall of money, but we do think there's, an incremental amount of money that'll probably come out of retail into the market as long as that economic growth remains stable and they're comfortable with it. So yeah, it's a key consideration, both from a volatility and sort of a horse race kind of perspective in terms of where you want to have your money.
Stuart, thank you very much. Stuart Kaiser there, my guest this morning on the markets. Coming up, the market moving events that you need to keep on the slate. Your trading diary, that's ahead on Bloomberg. Citi have just been with us. They say it's time to broaden your reach, go long of the Russell relative to your tech. But the world is not predicated all on rate cuts. It's time to take a little bit of risk, according to Citi's head of trading. Let me give you your trading diary for the rest of this week. The Atlanta Fed President, Raphael Bostic, hits the tape at 12:30 Eastern Time. More Fed speak. You can't get enough of it. New York Fed President John Williams on Wednesday. Plus, it is the deadline for the SEC to vote on, you got it, the Bitcoin ETF applications. Thursday, countdown to CPI and another round of jobless claims. Rounding out the week, it is the big banks hitting the tape, and they will define the trajectory for the mood music across Wall Street. That was it for Countdown to the Open. This is Bloomberg.